I think the macro regime has completely changed compared to the last 10 years. Over the last 10 years, you've had a disinflation environment where, in some cases, growth was okay. In some cases, growth was slower. But the determinant factor was that inflation was very, very low and very, very stable, which meant, Ed, that central banks always had this option, the so called Fed put, where they could simply come in and say, you know, I can support the equity markets and the bond markets because I don't have a problem when it comes to inflation. Now we head into the next 5 years and things have radically changed, I think. For one, I would say that politicians have understood the power of fiscal stimulus. We have seen it in 2020. If they really throw money at people, I'm not talking quantitative easing, I'm talking fiscal injections,
Yeah.
the economy picks up. And it's pretty obvious, if you ask me, because you're giving people money to spend, and at some time they will spend it and it will show up in economic growth. Now, when they understand this, they've also seen the flip side of it, which is inflation. If you do too much of that, obviously, you are giving too much spendable money chasing the same amount of goods and services. What happens is that goods and services prices are going to go up. Now, why am I saying this? For 10 years, between 2010 and 2020, fiscal stimulus was a taboo. It was austerity. It was the outcome of the great financial crisis that we needed to be much more strict about our fiscal spending. I think that might change a little bit. I don't expect fiscal stimulus to run very large every year, but I expect a pendulum. So I expect that when growth slows down, when inflation slows down, politicians now understand that by injecting money into the economy, they can quickly revive the economy. And so if this pendulum, and actually the other problem is, after the injection, there is always a fiscal cliff, exactly what we're seeing right now. So we're going to be seeing these fast pendulums basically being much more frequent, much more present than they were in the last 10 years.
Yeah.
That's the first source of volatility. The second one is definitely geopolitics. I mean, we are seeing rapid changes when it comes to the idea that you can have on-time global supply chains working flawlessly, and you can outsource manufacturing, you can outsource labor, and you're going to have every piece of your components reach your shore exactly when you want it to reach your shore, and it's going to be perfect, and it's going to lead to disinflationary productivity and growth. Well, I think this idea is being highly challenged. We have seen supply chains disruption all over the place. It's going to take a while, but developed market governments are looking for ways to become more energy independent. They're looking for ways to become more production, supply chain independent as well, which requires some tectonic shifts in the geopolitics out there, which also is a source of volatility. I mean, you're seeing Russia, Ukraine, you're seeing China, Taiwan, but you're seeing also US, China, where the US is trying to cut away China effectively from the semiconductor chip business in the world and making it impossible for China to replicate that very important technology. So all this geopolitical shifts happening will increase macro volatility. Effectively, I'm saying the big term trends have probably not changed. Demographics is terrible. Productivity is not going to explode. Debt levels are going to keep increasing. That hasn't changed, Ed. But the policymakers' reactions, the pendulum between growth and inflation, between recessions and periods of high growth and high inflation, I think that pendulum is going to swing much faster than the last 10 years.
Yeah.
And also the geopolitical theater is changing. So buy and hold is not going to work well in this environment. Active macro risk management, it's what's needed, I think, to navigate these periods better.